Hi, and welcome to Jankinsgaard on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're going to discuss the modeling of derivatives in the context of a corporate risk model. The purpose of which is to arrive at a better understanding of the many consequences of a derivative strategy and to simultaneously improve our understanding of the firm's overall risk profile. And how the derivative strategies interact with strategic objectives of the firm and its overall financial standing. So that's on the agenda. And for more on derivative strategies, please consult my book, Corporate Foreign Exchange Risk Management. There's also more information on my webpage, riskbudgeting.se. And as they say here on YouTube, please like and subscribe. All right, so we all know that derivatives are used in many different ways for a variety of purposes, many of which include the goal of making money by sort of outwitting the financial markets. You take a market view essentially, and derivatives allow you to do that, and with great precision, right? You can target exactly the kind of exposures you're looking for. But if you go to the literature on the subject, the academic writings on derivatives, the case for it is largely about keeping firms out of financial troubles and the negative consequences that occur when the firm is financially weak. So that you are, if you design your strategy well, derivative strategy well, you can make sure that you're able to meet debt obligations, for example, to keep you out of a situation involving bankruptcy or severe financial distress. You can also engineer your derivative cash flows in such a way that you help finance corporate investment. I mean, we know that firms rely on cash flows for investment to a great extent, and if that is lacking, they may underinvest, whereas tailoring the derivative strategy to take care of that could be value enhancing. So this is what derivatives are basically supposed to do if you go by the academic literature. And it turns out that it is indeed, these derivatives, we're talking about a very flexible tool here for engineering or sort of creating the exact risk return profile that you find desirable. And that means putting together different combinations of derivatives. I mean, they come in many flavors, right? So you can set up a portfolio with any combination almost, and choose different hedge ratios. I mean, you can hedge a fairly small fraction of your exposure or the entire exposure going forward. So that will obviously impact your risk profile, as will the choice of strike prices. If you're talking about options, right, you can choose one close to the current market rate, the spot price, or one far out of the money, and that will naturally have an impact as well on the. So you set these parameters in such a way that you get exactly the risk return profile that you desire, right? And you have 5 generic strategies, as we've seen in other videos. With those, you can then create essentially unlimited number of composite strategies, which are then combinations of different positions. So here you have various payoff structures for these 5 generic ones: sold puts, sold calls, bought puts, bought calls, and linear type contract. So these are the basic building blocks, right? You take those and you put them together in different combinations. You arrive at these composite strategies involving multiple derivative positions then. And here, for example, is the bear spread. You buy a put option and you sell one at the same time. And here you add more legs to your derivative portfolio and arriving at different profiles and controlling the exact amount of upside versus the amount of downside retain, etc. So it's highly flexible then. But they come with many drawbacks and surprises. I mean, this is often not highlighted. I mean, people take this very positive view of derivatives as if they were completely without any sort of cost or negative side consequence. But we know from actual experience that that's not the case, right? I mean, we do know that we get added volatility in net income because these derivatives are fair value accounted. And there's also potential margin calls that could disrupt your liquidity planning from having to inject more collateral in the form of cash as to deal with credit risk on as these unrealized losses get larger. So that could be very inconvenient as well. So to avoid any such surprises, we're going to propose a proactive due diligence of derivative strategies. I mean, sometimes these strategies are executed based on a hunch or some gut feeling or some feeling that it's going to be a good thing because it protects us. But it later turns out that there are indeed many surprises in store. You get these, even in so-called good scenarios where from a commercial point of view, things develop well. So you think you should be fine, but then you get some of these unrealized losses on these derivatives that you have to report in net income, potentially far exceeding your commercial gains because of how fair value accounting works, right? And then if there are margin calls connected to that, you could be in for some pretty rough liquidity requirements there. So we want to learn about these possible consequences and get informed how this looks, how this derivative strategy will look and perform across many different scenarios. Nothing should be a surprise to us. That's always number one as a risk manager. And the best place to do this due diligence is to, go to your corporate decision support tool and equip that with the right features that allow you to run various derivative strategies through it, so that you have a comprehensive view of the firm's forecast of financials. And within that, you can see how the derivative strategy affects corporate performance on multiple levels, like cash flow, net income, the balance sheet, financial ratios. There are going to be multiple consequences, right? And that we're going to need to get good at understanding. So that is referred to here as risk budgeting, where we look at the firm's the risk of the firm as a whole through the lens of financial numbers, such as cash flow, then net income, etc. And the idea is to have this model be, have full accounting and analytical integrity, so as to be a reliable tool for decision support, right? And we run multiple scenarios and evaluate different policies within this framework. This is explained in much more detail in other videos, right? But we set up a model here with a chart of accounts so as to create the right kind of accounting integrity. That then becomes the model set up in the forecast of financials. So you get net income, cash flow statement, and balance sheet reflecting your chart of accounts. And you want to make sure that this always hangs together, right? So what then when we're about to add derivatives to this model? We want to be able to run derivatives through this model, and we want to describe the financial consequences of derivatives accurately. Well, one thing is that you get obviously the cash settlement. It's a realized gain or loss when the contract matures. So you're going to have to either pay the counterparty or you're liable to receive some money, right? So that's settling the contract. But in the meantime, from between inception and cash settlement, there will be unrealized gains and losses. So that and they will be reported in the balance sheet as derivative assets and liabilities. So in the income statement, we have unrealized gains and losses, and in the balance sheet, derivative assets and liabilities. So we need to add these things to the chart of accounts to accommodate the whole thing. So you get realized derivative gains and losses referring to cash settlement, unrealized gains and losses to these changes in fair value, as I'm about to explain here. In the balance sheet, on the derivative asset side, derivative assets, derivative liabilities on the liability side. So that we need to take care of these new elements. So here we have inserted now in the income statement these realized and unrealized gains and losses. And here we have derivative assets and liabilities in the balance sheet. So we should be able now to deal with this. So let's make a few simple assumptions here to get going. We're going to hedge some volume risk here, some revenue risk, so that we're expecting to produce 1,000 units of some commodity, let's say oil, And it's evenly distributed throughout the year. This can be done in different ways. Here we're just assuming equal production in all 4 quarters of the model. And we have some hedging going on. Hedge volume 200 units now are being hedged, so that, and we're able to lock in a forward rate of 41, let's say. And this contract matures in the last quarter of 2001. So for some reason, we don't have to go into why exactly, but we just want to have in place a hedge in the 4th quarter of the next year, which that's our planning horizon here. So that shows up here as a volume forecast, and a forecast of hedge volumes here in the 4th quarter. So we're using these support lines, so-called, to deal with calculations that are necessary to be able to set up the financial statements forecasts. So I mean, we prepare certain numbers that will later go into financial statements. So we need some if formulas, as we nearly always do in risk modeling. So whenever we're in the indicated quarter, it will take the relevant hedging volume here and place that into that quarter. So we've asked it to go for Q4 2001, so that's where it shows up. And then we need to make a forecast of the price, because the derivatives are usually of interest when we vary the assumptions, and we get into potentially very good or very bad outcomes. That's when they're supposed to help us out, right? But first, let's see what kind of revenue we're able to generate from this particular scenario. Right? We're proactively evaluating this scenario. What if we were to see this scenario happen? So we're using our model for that purpose. So in this scenario, if that were to come true, we would see these revenue streams based on the volume assumptions. So we multiply the produced volume with the spot price. All the quarterly forecasts are lined up here, right? So we just multiply that with the volume. And for, we also need to model the hedged payoff then, which is, in the case of a forward price, is whatever you've locked in less what the spot price turned out to be, and you multiply that with the hedge volume. So in our case, we have locked in 41 by assumption that was the forward rate available to us at the time. In this scenario, it's 49. So the difference ends up being the payoff, and we're basically losing money. This is good from a commercial point of view. We're gaining over here revenue. So the hedge, in this case, we will be losing from it, and vice versa in a sort of scenario where the oil price is coming down, obviously. So we're losing money in this case from the forward contract. So, and one of the things that we should take note of here is that whenever we are evaluating future forecasted prices, there will be an automatically generated gain or loss from the fact that this forecast differs from the forward curve that you're assuming or working with. That's a given, that's handed to you by the market, but at the same time, your model, maybe you're using some algorithm or forecasting formula to come up with these numbers, and that's a different number than the forward curve. And the model will respond to that by immediately predicting a gain or loss, depending on what the difference is. And this is a puzzling feature because it seems like you can automatically, just get that gain or loss if your anticipated scenario comes true, and that profits automatically then go up, and risk as a function or because of that will go down. So you get a lot of these effects unless you calibrate the model forecast to the forward curve, so that they're initially starting out, they're identical. You can sort of force that upon your model, and then that goes away. Otherwise, it will look like you have this built-in gain or loss, right? So which could be tempt people to, either hedge or not hedge, depending on whether that goes in favor of your performance. All right, so we now incorporate this into our forecast of financials, so that the realized gain here, loss in this case, shows up here in the 4th quarter on this line here. And the income before tax is fed into the cash flow statement, and just since it's the only thing we're modeling right now, I just goes through the model and impacts cash ultimately. And there will be a corresponding gain in equity as a result, or sorry, loss, and therefore the balance sheet balances. The decrease in the cash position is matched by a decrease in equity. I mean, we have no ingoing numbers, so it's negative here, but never mind. And the balancing is there, and that's good, right? That's always what we want. But what about these derivative assets and liabilities then? I mean, this is not a complete model at this point. I mean, what most people do is to typically, to focus on the payoffs at the maturity of the contract. But we know that they're fair value accounted, so they will create a lot of impacts in leading up to that, in all these quarters in between. So for a proper due diligence here of the strategy, we want to see, get a sense of the magnitudes involved and what could happen, So what this means is, I mean, since we're fair value accounting derivatives, what we have to do is to, in each quarter going forward in the forecast now, we have to value them. Come up with a forecast evaluation of that position that reflects whatever market conditions we have assumed, right, in those scenarios. So if the value is positive, show it as a derivative asset. If it's a negative fair value, show it as a liability. And whatever the change in between two quotas, two balance sheet days is, that goes into net income as a fair value gain or loss. So this is essentially how derivatives are accounted for these days. Many items in the financial statements are headed towards fair value accounting, and we're supposed to get market values or proxies thereof into the financial statements on the basis that they're more informative. And in past times, firms used to be quite opportunistic when it came to derivatives, and they would report gains when that was to their advantage, and they would withhold derivative losses when it would have been inconvenient to report that. So there was this new set of standards imposed, which meant that we are basically going to report fair values now and make our best effort to come up with a value, unless there's an actual market value available. So that's what we're supposed to do, and meaning that we are going to make a predicted forecasted valuation then of this position in each quarter going forward, so that whatever in all of the scenarios, there's an actual valuation taking place, as if this scenario plays out, what would be the valuation of this contract in that scenario in this given point in time. And this is the topic for another video, exactly how that happens. We're going to set up some calculations here, but let's just, for now, keep it simple and assume we've done that. So we've taken care of those steps, and the model is returning a valuation for us in these quarters, so that this is what we would take to be the fair value of the contract, and that would be shown in the balance sheet. And the difference then between these two quarters, always two successive quarters, there's going to be a change. That goes into the net income statement as an unrealized derivative gain or loss, which is the whole point then with this accounting standard, that this is how it's supposed to work. You treat changes in fair value in this way, unless you apply hedge accounting, which we'll come back to. All right, so what now then? Well, we have, again, the realized gain or loss. Now we have added some numbers here on the line for unrealized derivative gains and losses, so that they appear here. Note that the unrealized derivative gains and losses are reversed in the final quarter when it's cash settled, because it needs to unwind. When the contract settles, there can't be any unrealized gains or losses outstanding. It will be replaced by a realized gain or loss. So we have to undo or sort of reverse all the previous gains or losses, which happens automatically here. So that there's a total gain or loss from this, it's the net of the two. Note that you wouldn't necessarily present it like this in actual financial statements, but for analytical purposes, it's great to keep track of the realized versus unrealized. Sometimes you would show some net number directly. Also, it should be said that not all firms show them on separate lines even. I mean, some firms will argue that realized derivative gains and losses are part of revenue because that's what you hedge, so they will include it there. Some firms will prefer to just make it a component of other operating expenses, for example, or you could possibly show it on a separate line. It's a matter of preferences, it seems. So, but also note, a lot of things to note here, but what goes on here is that the unrealized derivative gains and losses, well, that's fair value changes, right? So they can't have a cash impact. So we have to reverse them here in the cash flow statement. So that again, we see that it's only the realized cash settled component that has an impact here. It flows through the cash flow statement and into cash. And now we've added a starting value here, not in order to avoid these negative values on cash and equity. But what happens then is that there is a negative impact on cash that is mirrored by a negative impact on equity. But we're finding now it doesn't quite balance in the years in between. And we realize, okay, we've forgotten something. One of the great things about a self-balancing model, like the one we're discussing in this YouTube channel, is that it catches you out when you've forgotten something or done something wrong. It will not balance unless you're in the unlikely event that you have two errors that cancel each other out. You can take the non-balancing here to suggest that you have done something wrong or forgotten something. All right, we have forgotten to include the derivative assets and liabilities in this model. So that's why we're currently not able to get it to balance. So we need to go do that. Make sure the model has this feature built in, that the fair values are sent into the balance sheet. Right? So we're going to use some of these balancing lines. We have some for assets and other for liabilities, and the idea is to present the outgoing values that are then going into the balance sheet. So normally when we do these balancing lines, we have an ingoing value and there are corporate events like transactions and accounting events, and the balance sheet will just absorb these changes and produce a new outgoing value. When it comes to fair value modeling, we need to think differently because we have to actually build up the fair value from scratch. We are going to model the fair values. So we're getting the outgoing value directly, and we would rather calculate the change that results from this new outgoing value. So here, we don't know beforehand if we're going to use derivative assets and liabilities. It depends on whether the position ends up in the money or if it then ends up losing money. Here, in our case, we're making losses, right? So it would be reported as a liability. So we have this check here. If the fair value is negative, show fair value, otherwise zero. Here it's if fair value is larger than zero, positive, show fair value, otherwise zero. So it has to go into either, but it depends on what scenario you're simulating or assuming. And then this is the difference then in between the ingoing value, which is computed once we have this, we can derive that one. So it's the other way around in fair value accounting. But then this is the unrealized gain loss. So if you recognize these numbers, these are the those numbers, right? So that's how we got them essentially. We compute the change in this this item here. So now the whole thing balances because we have added derivative liabilities and only derivative liabilities have numbers, but so that is what it took to get it to balance again, and we've now considered all the various consequences of the derivative strategy, and we're able to see what the financials look like, how it behaves. This is a realistic depiction of the firm, apart from the fact that everything else is missing. But of the derivative strategy itself, this is how it would travel through these financial statements, and we now are informed, and we can run many different scenarios and see how this plays out and how it interacts with revenue that was held out of this to keep it clean. But of course, the point is to see how all of this fares when revenue is or gross income and these other underlying operating performance measures are showing numbers. We want to see if the hedging strategy balances that or sort of hedges that, and just get informed about the many consequences of derivative strategies on multiple levels. I mean, here you have the balance sheet and financial ratios that you can derive from that. You see here what happens to your income statement. You can see your cash flow performance. You don't have to be surprised. If you do this for numbers and arts, you can anticipate everything. And yeah, that's a good thing. We are going to believe, right? So yes, derivatives can and should be modeled in the context of a corporate decision support tool. We link it to the strategic context here, the firm's overall performance and whether or not we're able to meet these objectives that the theory talks of, right? So we can do a fairly thorough here due diligence of the many consequences of derivatives, thereby avoiding surprises. We're always looking to minimize those, right? It involves modeling realized cash settlements, but also the fair value changes, and then have the model incorporate that into a self-balancing sort of set of financial statements. So that would be the ideal for accomplishing this due diligence. All right, that was it. Please read more in my books on risk management. There's more on riskbudgeting.se, and please like and subscribe, and have a good day.